Hi, this is Stephen here from Navigator, and today we're going to share the bull put spread strategy, and it's credit spread. Here's an overview of what we're going to cover. You can pause the video if you want to read through that, but that's the flow of information for today's video. Okay, so is a bull put spread, is it a bearish or a bullish trade? It's a bullish trade, but you're only mildly bullish. A more bullish trade would be to buy the stock or to buy a long call, for example. So this is just a mildly bullish trade. It's a credit. You're actually getting paid in advance to place this particular trade. So what is the trade construction on this? Well, it's two separate trades, but when you're placing them with your broker, you usually place them as a combination trade. So the first trade is when you sell a put option at a strike price, we would recommend out of the money. And then the second part of the trade is where you buy a put option at a strike price, which is below the short put for the same expiry. So in essence, the bull put spread is the short put strategy with a bit of insurance underneath it. That's what it is. So let's go to our Interactive Brokers demo account and do a trade for real. Here we are now in the Interactive Brokers demo account. We're going to place the trade. So we're in the order management window. We're going to click on spread. And this is a vertical spread that we're trading. So let's do an example, for example, with Microsoft. So we'll click on Microsoft. And you can see that two order windows are going to open up down here. Now, we're going to start left to right here. I always like to start with the short put end of things. So we're going to sell the Microsoft. We'll change the expiry to June the 19th. Now, Microsoft, I think, is trading at about $48. So we'll change this. We like to go out of the money to 45. And we're going to change it from a call to a put. So you'll notice that automatically the second trade changes to a put as well, because they recognize with a vertical spread it has to be the same type. It's not a call and a put, it's just two put trades. So that's the first part of the trade. The second part of the trade now, the strike we need to pick is a strike price below the short put. So let's say we pick 44. And you can see we've bid-ask spreads for both of them. Now underneath here you'll see the overall trade placed is 1. So it's a credit spread, it's one contract we're doing, and you're seeing it's a limit price of 14 cents. So what they've done here is, if you think about it, you're taking in 63 cents on the first part of the trade, but you're paying out 49 on the second part of the trade for the insurance. So the net bid is actually 14 cents. And they do the same on the ask side. Now, normally we would say to you, haggle. If this was a real life trade, we would say haggle here and look for 16 cents, somewhere in the middle. And more than likely you'll get filled. But because we're demonstrating here to you, we're going to click on 14 cents as a limit price and click on preview order straight away. So then you get your preview order. Are you sure you want to place this trade? Sell the $45 put and buy the 44. We do. We click on submit order, and that order has gone into the system now. So we'll go back into our system. You'll see our positions tab here, and that'll be updated shortly now when the orders actually appear in the system. So you can see there they've just appeared. We're now long on the $44 put and we're short on the $45 put. So that's just an example of how you would place a trade. We're going to do a real life example now and go back to the presentation. So here we have a real life example of a bull put spread. Back in April, SPY was trading at 204.78. We placed a 196.195 bull put spread for the April 17th expiry. So it was two trades that we placed as one. The first trade was selling the $196 put, and we received 98 cents per share or $98 per contract. And the second part of the trade was the insurance part of the trade that we bought. So we bought the $195 put and received 87 cents per share or $87 per contract. So the net income to us was the 98 minus the 87 was 11 cents per share or $11 per contract after costs. So what's the risk in this particular trade? Well, it's totally limited, and it's limited to the difference between the strike prices minus your credit received. So taking our SPY trade as an example, the strike prices we picked were 196, 195. The difference between the two of them is $1 minus the credit received, which was 11 cents. So our total risk was 89 cents per share or $89 per contract. What's our max profit potential? So you're going to see again in our graphs here that our upside is absolutely limited, but so is our downside. That's the good news here. So you'll know your risk and reward before you even enter this trade. So the max profit is limited to the amount or the credit that you received. And in this case, it was $11 per share. Now, we achieve our max profit when the share price finishes above 196. So when you're placing a bull put spread, once the share price finishes above the short strike price, you're going to make your full profit. What about break even? Well, on the break even side, it's equal to the short strike price minus your credit received. So for the SPY trade, our short strike was 196. We received 11 cents as a credit, and our break even therefore is 195.89. So if at expiry Friday, the share price of SPY finishes above 195.89, we will achieve a profit. So what is our leeway or our downside protection here? Well, the current share price of SPY was 204.78. Remember, our break even was 195.89. So the shares could actually fall 8.89 and we'd still make a profit. So they could fall about 4.4% and we would still make a profit in this particular trade. And this brings us into the next section, which is probability of success. So any good brokerage house will have a probability calculator which you can use. Now, in our particular broker, we had an 86% chance of winning. So it's a high probability trade. Now, we still have a 14% chance of losing, but you might be thinking back, oh, they only made $11 per contract. We might do 5, 10 contracts of that particular transaction and have an 86% chance of winning 5 times 11 or 10 times 11. And that's a high probability trade for this particular underlying, which is SPY. Now, what are the effects of volatility in a bull put spread? Well, that really depends on whether the puts are in the money and also the time for expiration. But really, what you're looking at here is the effects of time decay. So if SPY is trading closer to the higher strike, in our case 196, profits usually increase at a faster rate as time passes. But on the flip side of that, if SPY is trading closer to the lower strike or the insurance end we bought, losses usually increase at a faster rate as time passes. So picking the strikes, how do you go about doing that? Well, there's a couple of things you need to be aware of. It can depend on the degree of how bullish you are. So if you're very bullish on the trade, you would pick strikes that are in the money. Now, we would not recommend that you do that. We would prefer if you used out of the money strikes. If you're moderately bullish, you'd basically pick share price or strike prices where the share price is stuck in the middle between them. And then the least bullish trade of all, which is the one we did with our SPY, is where both puts are out of the money. And usually we're placing this to take advantage of time decay. So all we're looking for is a high probability trade, getting paid a premium right up to expiry, which is benefiting from time decay as each day passes. And that's the type of trades we like to place here. Now, one other note here is that the wider the strike prices, you notice we only picked a dollar wide strike on our SPY trade. You could pick $2, $3, $4. Your premium will be much bigger, but so does your risk. So our risk with SPY was limited to 89 cents or $89 per share. If we had picked a $2 wide strike, our risk would have been much higher than that, but we would have got paid more. So you can manipulate your risk and reward by picking your strikes very carefully and deciding whether to go in the money or out of the money on the strikes. So how do you manage the trade? Well, a couple of things you need to be aware of. You can close the trade at any stage. The trade can go into profit before the expiry Friday, and you can close the short put by buying it back, and you can close the long put by selling it. So you can close both sides of the trade early if you wish. But normally you would leave it till the expiry date. Now, if the share price is above the short strike at expiry Friday, do nothing. There's probably no value in your long put, and your short put will also expire worthless, so you'll make your full profit. However, if the share price is below your short strike, it could be a losing position, and you will have to buy back that short put at a slight loss. And if there's any premium left in the long put, you could sell that as well to offset some of your loss. But remember, your loss is absolutely limited. You know that before you even place the trade. So this is Share Navigator. That's free training. Please share this with your friends via your social media outlets. And if you go to our website and log on, you can get some of our trades live. This is Stephen. Thanks and bye for now.